Hello, everyone. Welcome back to another episode of Finance Schminance, the money and investing show that approaches financial topics with a little bit of levity, humility, and hopefully a little bit of humor today. I'm Nick Rossalillo. Joining me is Mark Evans. He is California State University Bakersfield's economics professor emeritus, also co-director of CSUB Center for Economic Education and Research. And most importantly, he's my Uncle Mark, my actual real world Uncle Mark. Thanks for joining me today, Uncle Mark.
Well, thanks for inviting me, Nick. These are uncertain times, and I certainly hope that my presentation clarifies for a little bit for your clients what's going on and helps them move forward.
Yeah, uncertain times for sure. Stressful, given what we're facing right now. So just a rundown on what we're going to talk about here: inflation and how we got here in the first place, the Federal Reserve and its response to this. Maybe I'll touch a little bit on the market and its displeasure with both situations right now. And hopefully, like you said, we're going to try to shed a little bit of light onto what is actually happening out there. So I guess the first place we should start, Uncle Mark, is how we even got here in the first place. What happened to cause all of this inflation, and then the ensuing Federal Reserve response to it? But the March Consumer Price Index inflation, 8.5%, largest year-over-year inflation rate since the 80s. What's going on? How do we get here?
Okay. Let me start by saying I'm saying all of this with a bit of humility because I don't have a crystal ball. But that said, let's jump in. Let's look at the pre-pandemic conventional wisdom, okay? Because COVID really is a unique challenge. And I think it'd be useful to take a look at the history that immediately preceded COVID and the pandemic and all the shutdowns, and then what the received wisdom was at that point in time in terms of how you deal with inflation. So on the left here, there's a summary table, of 2017, 2018, 2019, the major macroeconomic variables. And what you see that, before COVID hit, we were running along pretty consistently with a GDP growth of around 2.5% or so a year, give or take. Unemployment rate that was, inching downward, starting at 4.4%, which is not bad at all, and finally reaching 3.7 by 2019, and then through this kind of moderate growth and slowly decreasing unemployment, a pretty steady inflation rate right at the 2% target that the Federal Reserve had established. So what were people thinking in terms of how the economy works, in this environment that we were in? So, well, one of the key factors economists look at is something called the non-cyclical rate of unemployment, or on these slides, I referred to it as UR star. So this is it's something you can't turn on a microscope and see what it is, or open a book and read what it is, other than you can maybe read a study where somebody's trying to estimate what it is, but it's really an unknown factor. And I think the easiest way to refer to this is it's the inflation trigger, in the sense that when the unemployment rate falls below this for an extended period of time, inflation tends to increase over the range that it was. And if the unemployment rate drifts above it, then eventually what you're going to see is the inflation rate inching downward. And what we thought at this point in time is, wow, this inflation trigger over time, we can see that it's really declined. There was a time, maybe 1970 or so, where we thought it was, over 6%, and then gradually it's declined over time. And then we're in this period from 27 to 2019. And what economists are thinking is, I wonder what this is. This could be less than 4%, maybe even less than 3.5%, because the unemployment rate's been running, in the low fours and high threes, and we're not seeing any acceleration in inflation.
Mm-hmm.
So I think this is going to be part of what the Fed carries with them as they're trying to figure out, how to handle the
Mm-hmm.
pandemic. And
Okay.
then secondly,
Sorry. So just to clarify then, basically UR star, basically unemployment rate, anything above conventional wisdom, this is before the pandemic started, anything above 4% could kind of cause deflationary forces. And then anything below
if it's
4%.
persistent, well,
okay.
Maybe 4. The semi-official estimate still is that it's like 4.5. So somewhere, there is a trigger somewhere.
Okay.
And that we tend to think of inflation and deflation or disinflation from the point of view of, if you're trying to do something about it, you probably have to bring unemployment above that trigger,
Okay.
to wind it down. And so the wisdom at this point in time is, wow, that trigger will allow us to get a pretty low unemployment rate before we have to worry about it.
Okay. So basically, yeah, too low too low unemployment rate. It could be either too many jobs and not enough people, basically, and that sustained for too long a period of time could help pull inflation up.
Correct. And the way it does that is the labor market really turns in favor of employees.
Mm-hmm.
So they have the bargaining power, so they can negotiate for higher and higher wages. And then if you're a business, demand is so strong that you feel like you can grant those pay increases, just mark them up, and the customers will still be there.
Okay, that makes sense.
Or if it's a high unemployment rate, then it's the same. Employers are more worried about, can I pass along these cost increases if I grant them? And then labor's thinking, I just want to hold on to my job. I'm not going to be too pushy.
Mm-hmm. Okay, that makes sense. Where are we at here now? Do you want me to move to the next slide?
Move to the next slide. Yeah.
Okay. So now we're moving on from that's the conventional wisdom.
Yeah. So now let's talk about inflation in just a little bit more detail, because really, if you have inflation, the best disinflationary policy is really going to depend on exactly where you are. And I think I am lost. Okay, here we go. So basically, we still, what we just talked about, we still kind of feel that conventional wisdom holds, that there is an inflation trigger of somewhere. We don't know exactly where, but it's probably somewhere around 4%. So nothing's changed. What's just changed is, the environment that you're trying to operate in, and you're going to just kind of use these rules of thumb to get your way through it. So if you look at a little more broadly at inflation, what we talked about was this demand pressure term, which is going to depend on the unemployment rate versus this inflation trigger. But there's two other important components. One is just inflationary expectations. Because again, if people expect 5% inflation, if you're labor, you're going to kind of expect 5% just so you can hold where you are. If you're an employer, you're going to grant it because you expect to be able to raise your prices 5%. So
it's like a self-fulfilling prophecy, basically.
It's a self-fulfilling prophecy, and inflation kind of has this inertia at some level. It's a different level in different countries. It's a different level at different points in time. But whatever it is, it would then tend to bump up or down a little bit depending on this persistent demand pressure we just talked which we tend to think about in terms of whether the unemployment rate is above or below this trigger.
So I guess maybe if we could pause there for a second, because I'm just trying to think of it like in terms of like a business owner. I think maybe I own like a restaurant, let's say, or maybe I'm like I have a metal fabrication business. I think my costs of doing business are going to go up 5% next year. So therefore, on that expectation, I'm just going to raise my prices 5%. And then my employees know that we're raising our prices 5%. So they expect to get a 5% raise. And so basically I'm fulfilling my own prophecy in a way.
Exactly.
Okay, interesting.
And what's basically happening here is you're searching for that rate where neither side feels like they have extraordinary bargaining power over the other side. So they're not trying to push it beyond just holding their own in real terms.
Okay, interesting. So that's still kind of conventional wisdom then at this point.
It's still conventional wisdom. And then there could also, and the way this would work then is if the Fed's trying to do something about inflation, it's through this managing this persistent demand pressure, just trying to move it to some different level. The way they do that is they affect borrowing conditions in some way. That changes the GDP growth rate. That ends up changing the unemployment rate. It ends up moving actual employment relative to this inflation trigger, which will then affect the inflation rate, the rate of, which will then bounce back and affect people's expectations of what they're expecting. So there'll be these feedback loops between what's actually happening and changing expectations. Okay. But then there could be just these things out of the blue, like these transitory supply shocks. Anything from a earthquake, hurricane. One of the things I think affecting computer parts the last few years was actually just a fire in a major factory in Asia that was producing computer parts.
Right.
Natural disasters, crop yields, OPEC gaining or losing strength, what it does to the oil market. And then with COVID, it was just these supply chain disruptions and labor force disruptions. Now, the thing about a transitory shock is there's kind of a one-time burst in the inflation rate, but then whatever's causing that maladjustment, prices adjust. There's like a one-time adjustment to the price level, and that solves the problem. So the inflation then returns to its original, level. It doesn't stay at the higher level forever.
So in some respects, and I know also, one of those one-time shocks, if we want to call it that, is now like the war in Ukraine. That might be another thing. And then I know when we were prepping for this show, we talked a lot. We talked a little bit about, like the ongoing lockdowns in China and how that's kind of creating shocks in supply chain as well.
So sadly, we kind of thought we were at the end of it, but then, with the vaccinations and increased immunity and that sort of thing, but then you get the new variants and you get the new lockdowns in China and the war in Ukraine. So even if most of these shocks were transitional, to some extent I mean, if you have something that's transitory forever and you have one transitory thing after another, it's no longer a transitory thing. I think that's kind of like and that's the last point of my slide, is like transitory and persistent. These are like fuzzy terms and one can morph into the other.
Yeah, right. Like you said, we've been having multiple transitory events for 2 years straight now. So
yeah. And I guess, I mean, I'm not very happy with what's happened to my portfolio, but
Yeah,
At
me
the same
neither.
time, I don't see, I mean, the world's an uncertain place. And this stuff's going to happen. And if I want a rate of return higher than my credit union will give me in my savings account, the reason I can get higher return elsewhere is that all these risks start becoming part of the equation. So
Mhm,
it's a decision I made.
mhm.
I don't want to settle for a 1/4 of 1% rate of return over the last several years in my in a savings account. So I've decided, I would rather have a little bit more risk and a little bit higher return, but I mean, the risk is there.
Mhm.
And
Yeah, and
the
lots of
world's
them.
an uncertain place.
Yeah, right. Lots of them. So I guess at this point, we can say maybe not so transitory anymore. Some of these things are not so transitory anymore. I'm just thinking maybe here, if we could, can we skip to the slide here about how the pandemic, when it started in 2020, it kind of changed some of these points of
uh,
conventional wisdom?
yeah, it's not so much that it changed them, is it, like, implementing the policy depends on correctly assessing whether it's persistent and whether it's transitory, and correctly assessing whether you're above or below that inflation target.
Okay.
So it's not so much that we decided, we thought the world was flat and we no longer think it's flat. It's just that the theory hasn't changed, but it depends on kind of assessing the environment to see which, what the appropriate policy is.
Okay.
If we can go back one that we skipped,
Sure.
I'll just do it in like 15 seconds, so we can move on.
Oh, right, right. Okay.
Yeah.
Yes.
So here, what I was trying to say is, if in fact it's transitory,
Hmm.
as on the left, you can hold the unemployment rate at 4% or something like that, and what'll happen is that inflation will dissipate on its own and eventually return to your target rate without you ever having to increase the unemployment rate.
Hmm.
But if in fact it's persistent, and you're in an environment where that unemployment rate is below the trigger, you're going to get what's on the right, where as you try to maintain that unemployment rate where it was and keep it from eroding, that temporary burst will turn into like a permanent
Okay.
increase.
So the
And
Fed
so
basically needs to bring,
the Fed was basically thinking that their environment was as on the left,
mhm,
but there was enough of an element of what's happening on the right, in terms of uh, the transitory drifting into permanent or persistent, and at the same time, perhaps trying to peg that unemployment rate at 3.5, below 4%. It may be that really that's on the wrong side of the trigger.
okay, that makes sense, right? So we got to cool the economy off somehow to bring that inflation
Yeah.
back down.
So what we did in 2020 is we just pumped an enormous amount of fiscal, stimulus into the system. Over $3 trillion between the March 2020 and December add-on with the
Mhm,
CARES Acts. And then the Fed, as you know, said we're going to cut the federal funds rates to very close to zero. And going forward, we're going to keep it there for a long time. Uh, and then massive purchases of debt securities. So you can see what happened here is in fact, I would say it was a good response in that,
mhm,
look at the decline, look at the collapse in GDP in the first and second quarters. Uh, just as the pandemic started, you had immediately a 5% annualized decrease in GDP. And by the second quarter, it hit roughly a third of the entire GDP,
mhm.
but it bounced right back in the third quarter and fourth quarter. So this really was an effective rescue. um,
Sure.
the unemployment rate, it went up to 13%, but by halfway through the year, it was declining again, and actually it became roughly half that rate by the end of the year.
Mhm.
So this was, I think 2020 was really remarkably effective.
Yeah, and interestingly, during all that stimulus, inflation, as you have noted on the right column there, inflation stayed within the Fed's target rate of 2% all along the way. So you could
Pretty
see why they would
much,
think,
pretty much.
yeah, it's going to be transitory.
So I think at this point, they're looking back to where, okay, let's look at the previous 3 years pre-pandemic. We got down to 3.5, between 3.5 and 4% unemployment, and that inflation didn't pick up. So we're still sitting at maybe 6.8% unemployment. So we can continue stimulating the economy. but the problem was that the stimulus had already occurred and the multiplier was working its way through the system, but it wasn't completely worked through yet.
Okay.
The economy was still
slowly.
growing, but they weren't looking at how much more is it likely to grow.
So, okay. So then I guess that takes us then to, maybe where all of this started to go wrong then in 2021, which I'm sure is debatable, but, well, walk us through this here. Like where did the Fed kind of maybe make a few mistakes or maybe just act too slowly?
Yeah. And here I think, the fiscal side really blew it here. Congress and the president, to me, in my opinion, because the Congressional Budget Office estimated that we were probably $50 billion stimulus away from full employment at the beginning of the year. And because the multiplier was working its way through the system, we would only be about $20 billion a month short by the end of the year. But the American Jobs Act pumped $150 billion a month into the economy, when somewhere between 20 and 50 was the estimate of what was needed to reach full employment. So again, these are politicians, the more the better. And I do remember here, this doesn't speak very highly of Trump or Biden, so I can say it and be nonpartisan. But after the last stimulus, they were suggesting, or they pumped in that December added about $600 a family or so, and it was bumping right up against the election. So Trump said, they're all just vying for the vote. He said, well, that's ridiculous. It should be like 2,000 instead of 600. And then Biden countered with, I agree with you, Trump. It should be 600. It's $1,400 short. So as soon as he got in, he introduced another package to add another $1,400 to the original 6 to make it the 2,000. Well, it was just too much. But okay, so the way the world's supposed to work is the politicians are just crazy. I mean, whatever comes out in legislation, I shouldn't say they're crazy. I should say they're very rational in pursuing votes, and and you get the votes by giving people additional stimulus. You get the votes. Well, at any rate, the problem is that we understand that crazy things are going to come out in terms of discretionary fiscal policy because it's a political process. But we've really relied on an independent Fed to be the counteroffensive to that, where if the Fed or if Congress and the president do something that's going to throw the economy off, we count on the Fed to counter stabilize it. So if you're, you can be mad at politicians, you can be mad at the Fed, but the Fed's in a situation where it can't control in the least what Congress and the president do. They have no control whatsoever over this way too large stimulus. We're just in a position where, what do we do about it now? And well, what they did is they were still probably worried about 6.8% unemployment at the end of the previous year, that last quarter. So they just, in their March meeting, announced we're going to keep that federal funds rate around 0%. We're going to keep it around 0% for the rest of the year. We're going to proceed with our quantitative easing. So they basically said, we're going to just go with the status quo until we get that unemployment rate all the way down to where we want it, 3.5 or so. And it shouldn't be inflationary because it wasn't in 2017, 2018, or 2019.
Yeah. So I guess maybe just to reinforce your point, like, stimulus, fiscal stimulus is going to be fiscal stimulus. The Fed just does what it thinks it needs to based on whatever's going to come out of that. And I guess the backdrop amongst all of that too is, many households in the US were struggling at that point. So was it a lot of stimulus? Yes, but for a lot of people, maybe they needed it. COVID was still going through the economy.
Yeah.
In hindsight,
it was a tough,
it was a tough
there's
period.
a rationale for doing it. There's a lot
Yeah.
of people hurting, but it just ends up, it was probably too much given what the economy could sustain.
Yeah. And so in hindsight, the Federal Reserve could have started raising interest rates in early 2021.
Yeah. Or at least mid, at least mid. Oh, I see. I thought, yeah, with the additional stimulus, I would say yes.
Okay.
It probably should have started, I would say, early in 2021.
Okay.
To try to offset that.
And so here we are. You've got a visual here just to kind of show that again with charts. What was supposed to be just kind of a short-term inflation burst turns into that chart on the right.
Right. Like what they basically ended up with what's on the right because they weren't proactive. Now, what if they would have been proactive in beginning 2021? We'd be yelling at them then instead of now. Because how would they have done that? They would have raised interest rates then, and stock prices would have been going down then.
You mean to tell me we're just always unhappy?
We're just always unhappy. Not always, but what goes up must come down.
Yeah, for sure. Okay, so all right. Hopefully, hey everybody, I hope you're still with us here. We're talking math and economics. Let's fast forward now to 2022. Uncle Mark, what is the Fed trying to do now? Because obviously we have the benefit of hindsight. It looks like maybe things could have been done slightly differently. So now the Fed is raising interest rates and everybody's upset now instead of in early 2021, like you said.
I'm sorry,
what are you
Nick,
trying to accomplish here?
Okay, I'm sorry, Nick, but your clients are going to be mad at me.
That's okay.
I'm going to say they're probably not raising rates enough. But anyway, okay, so they have recognized that now there's really an unemployment rate that has declined substantially already. There's broader price pressures beyond the pandemic. Okay. So they announced recently they're going to raise the federal funds rate immediately by 0.25%, and they did. And then they said they anticipate raising it 1/4 to 0.5 point or so every meeting through the end of the year. So it will probably be around 2% as opposed to somewhere between 1/4 and 0.5% at the end of the year. And then they've started quantitatively tightening by basically reducing their holdings of these securities, which what that does is it draws excess reserves out of the banking system and makes it more difficult for banks to make loans.
Kind of pulls some more slack.
Yeah, and there's a lot of excess reserves in the system, but it's going to start pulling them out.
Right.
And that would also put a little bit of pressure on longer term interest rates that would probably discourage investment spending or housing or something like that a little bit, which again would nudge that GDP growth rate down a little.
Okay, so yeah, this is the challenge, right? As you mentioned, from an economic standpoint, they probably need to raise rates more than they are. from an investment standpoint, the market is really upset that they might be raising rates too much as it is. And so, the NASDAQ is more than 20% down from all-time highs. It's pitching a fit because the Fed is doing this. It's kind of a trade-off here between, market strength versus economic strength. But what do you think about, the Fed keeps talking about, like, they think that they can make the soft landing. They can basically, they think they can raise interest rates without crashing the economy, which obviously would be a lose-lose, right?
Well, I think what they think is they can, if you look at their median forecast on the right, what they think they can do is basically lower inflation. Like this scenario, what's happening in this scenario is inflation's decreasing from over 7% in the fourth quarter of the previous year to 4.3% this year, and within a couple of years back down to their 2% target. But it's doing it without any increase in the unemployment rate. In other words, the interest rates are increasing enough to slow down GDP a little bit, but not enough to slow it down enough for the unemployment rate to start increasing, and for that to then kind of start pushing back at the demand pull inflation.
So could we maybe frame it this way? If the Fed is successful in this soft landing, essentially, the stock market in particular, maybe even the bond market as well, it's kind of upset with what the Fed's doing with interest rates. But if successful, the market is taking it on the chin, but it's keeping people in their job. It's keeping people employed.
Not only that, but if it plays out successfully, then the market's going to quickly turn, and recover its losses.
That's true, because earnings have been very positive still. The companies are still growing despite all of these interest rate worries and inflation worries.
Yeah.
Okay. I just wanted to make sure I had that clear. So but that's like, if the soft landing is successful, let's see here. Maybe I'm getting ahead of myself here.
Yeah, so I what I'm suggesting here is that, there's enough demand pressure that I don't see how they can lower that inflation rate without making sure there's still enough stimulus in the economy for the unemployment rate not to increase at all.
Okay.
Because what typically happens is, once you realize that some of this is just the fundamentals of an overheated economy, then what you do is you raise this unemployment rate over time above that trigger, and then you get the disinflation. So at this point in time, they're not really talking about the need to do that. They've presented a scenario where you come into a soft landing without any decrease in the unemployment rate. And I don't see how that happens, because that would be like, it's like going back to the diagram on the left and saying it's all really transitory and it's going to disappear by itself. If it's not going to disappear through labor markets getting a little bit of slack, then why is it going to disappear? Well, it must be transitory then. So in a way, they're talking like they've changed their outlook, but their policies don't represent the change in outlook.
So I am curious about this, and this maybe relates to the economy, but also the market as well, and what it's trying to figure out here. Could it still be transitory? Like, let's say by this summer, the lockdowns in China end, maybe some of the effects. Well, that would be fantastic if obviously the war in Ukraine ended, but if not, that's best case scenario. But if not, like maybe some of the shock of that in the energy industry kind of dissipates. Could it still be transitory by this summer if some of those worries dissipate?
What it is it's a mix of transitory and demand driven or tight labor markets. So you could get some some pullback of inflation based on the that transitory part of it, kind of rectifying the ship. And I think you may. But the problem is that it's clear that the inflation already is getting baked into the wage price cycle.
Okay.
So how do you get it out of there? I don't think that like the decrease in inflation just based on that transitory element is going to be enough. I hope I'm wrong.
Here's one other scenario that I've been thinking about too. So when preparing for this, I asked you about first quarter 2022 GDP. It was only 1.4%, which was a lot less than I think we were all expecting.
Yeah, it was actually negative 1.4%.
I'm sorry, negative one. I'm sorry. Yes, that's a big difference. Negative 1.4%. So one more quarter of that. Let's say the second quarter GDP comes out later this summer in July, and it's also a negative GDP number. Would that change things as well if we end up having like subsequent quarters in a row where interest rates are still relatively low? We're still kind of dealing with some of these transitory issues, but maybe they start to dissipate a little bit. Could that a lower than expected GDP reading help with this problem as well?
It could. The problem is the first quarter GDP is a one-off number. It's caused exclusively, demand is still very high. Consumer spending was very high. Investment spending was very high. But what happened is in the fourth quarter, there was a tremendous buildup of inventory. I mean, there were a lot of goods. We know that there's supply constraints at the ports, but there were more goods flowing through those ports than ever historically. I mean, it's just the backlog was so huge that it's still there. So what happened is we built up our inventories tremendously in the fourth quarter because, just to hedge against that risk of not getting your product. And then in the first quarter, they sold a high level of goods, but they sold them out of it, taking down inventory instead of new production. And what the GDP is capturing is just new production.
Okay.
So because the demand and the purchases were so high, people are saying that, the change in GDP is just a one-shot deal.
Okay. That's an interesting point too, because I think we worry about like the amount of goods flowing through those ports and the backlog, but in spite of that, like it was still hitting record levels. So we're still basically trying to catch up from all that lost.
There's huge catch up still.
Yeah, from 2020. Okay. That's interesting. So perhaps first quarter was just a one-off event. And then maybe, I guess we've covered some of this already, will it work? Is a soft landing even possible at this point? There's a lot of different scenarios, but will the Fed, they're aggressive. It seems like they're getting increasingly more aggressive with the interest rate hikes. Like Jerome Powell said a couple of weeks ago that 0.5% interest rate hike is on the table this week. Is it going to work? Is it possible?
They're still a little bit behind the curve in terms of when they should have started bumping it up in 2021. So I think what the markets should do is just kind of capitalize it in, if they haven't already, that these rates are going to happen. I think the reason the stock market's going down is the typical investor probably doubts that they can pull it off with a soft landing.
Absolutely. That's definitely what I'm saying is I think the market's a little bit different from economics. I think, like in your field of work, Uncle Mark, you look at things very rationally, but like from an investor standpoint, we're like a pendulum swinging back and forth between ecstatic and the other end. When the pendulum swings back, it's like, oh my gosh, the world is literally coming to an end. So we're like constantly dealing with like these swings in the pendulum from ecstatic to just this feeling of foreboding, and we never stop in the middle and feel rational about things. So yes, you're right. I think we are basically pricing in a hard landing from the Fed. We think the Fed is going to totally mess this up and cause a recession at this point. That's what the market is pricing in.
Well, I would phrase it differently. I think they're behind such a huge 8-ball that it's not simply a matter of messing it up. It's a matter of it's just such a hard thing to pull off that it's not like even if they did everything correctly, there's still, I think, a pretty large chance that that they're going to overshoot. But then on the other side, if they don't, we don't want to bake in this 6% inflation forever and have it ratchet up to 7% and then ratchet up to 8% there. And that's the other side of the coin. And that's the permanent situation that they're trying to avoid through some, you take your foul tasting medicine right now and you'll be better for years into the future.
That's a good point. It's hard to have that perspective when we're in the moment dealing with it. But really, like, if we're thinking over the course of years, did they start like tightening too late? It looks like we can make the argument that yes, they did, but like, we're only talking about a year in the grand scheme of things. It's still kind of a fixable problem. Like, it's not permanent damage, I guess.
No, it's not. The economy, if it goes into a recession, most people are saying it's going to be a shallow one, and it's not going to be very long. But it is. But many people are saying, but there will be a shallow one that's not too long.
And from the official definition of a recession, at least how some government bureaus define it, we're halfway there already with the negative 1.4% GDP reading.
Well, no, because that was just for one quarter.
Okay, but if we had like a second quarter,
we would have to, for the entire year. Wait, or is it? I can't remember. It may be for 2 quarters in a row.
I think some definitions call it just 2 quarters.
Yeah, 2 quarters. Yeah, but it's not going to happen.
Okay.
It might happen later, but it's not going to happen in second quarter 2022 because it's such a one-off, outlier.
Okay. So a lot of worry here, I guess, regarding what the Fed is going to do next. Behind the curve, they're trying to catch up. That's basically what's happening right now. We're battling inflation, and for the time being anyways, we as an investor, maybe even as just workers in general, if unemployment kind of inches up a little bit slightly because of the interest rate hikes and quantitative tightening, we might feel it a little bit here in the short term as the Fed tries to get this problem under control. Yeah.
And, from their point of view too, we talk about interest rates going up, but what really affects decisions is the real interest rate or the rate taking out the inflationary premium. And those rates are still very low, in fact, negative.
Right.
Because inflation's running at a higher rate than nominal interest rates. So, and they're looking at it that way and saying, have we really even raised rates at all in real terms? Because the inflation's grown by much more than we've raised nominal interest rates. So
yeah,
that's almost making money cheaper. So I think that what's being baked into the market is not so much that rates have gone up a little bit or they're going to go up a little bit more, is that they're afraid that'll trigger the recession.
Right. Exactly. Because then in that case, the worry among investors is when there's recession, usually you have earnings declines. And that's really all the market is ultimately concerned with is, are the
Right,
businesses we're
right.
invested in, are they still profitable? Are they still
Right.
making money? Yeah, that's interesting. And that's probably a completely different topic we could have about real interest rates versus like the Fed rate, because they are negative. Those real rates are negative. And that's a fascinating phenomenon that the Fed is raising these interest rates. We expect them to raise these interest rates, and yet the interest rate on like a 30-year treasury is still what, 3.5%, 4%,
Which would put it in negative territory on in terms of the real cost of paying off the loan.
It's a bizarre situation.
Because if inflation's running at 8%, you're probably going to have 8% more money, or the money you're paying back is going to be worth 8% less, and you're paying 4% of it back. So,
well, I guess maybe the ultimate takeaway. The Fed's meeting this week, so we're going to do a brief follow-up later this week to cover maybe any changes in the Fed's assumptions and comments they make regarding their interest rate decision. I think as far as an investment standpoint goes, I think what we need to watch for at this point is not the interest rates so much, because the market fully expects now that interest rates are going up at the Fed.
So it's already baked in. I think.
It's already baked in, but how does the Fed's actions affect the economy? And I think that's now the worry has changed from the interest rate itself to, recession, basically. Do the interest rates?
And honestly, I think that part of it's already baked in to a large extent.
Yeah.
So, which basically means, we probably all can be assured to some extent that, it's not that the market's going to decline a bunch more if there is a mild recession, because it's probably already baked in.
Right.
The market, that probability of that happening.
I tend to think the same thing, especially, if we have a longer term horizon, at least 3 to 5 years. But the more the better. The longer term, the better. The probability of permanently losing money in the market, I think, is significantly less today than it was, say, at the end of 2021. Because of what you just said, the market is now at this point baked in the interest rate hikes, some sort of mild recession. And at this point, things can, I don't know if they can always get worse, but at this point, the probability looks good for things to improve for the market rather than continue to deteriorate. That would be my thinking.
Yeah, it's not going to go crazy, in the direction we would like anytime soon, but I think we've probably seen a lot of what we're likely to see in terms of the decline. And I think the people that should be most worried are those that are living off of dividends and stuff like that. But if you're, depending on your age, if you're not 70, 80 years old or something like that, and you're basically living off of your portfolio, wait it out and you'll be fine. I think.
Right. Yeah, that's really good insight. I really appreciate it, Uncle Mark. I think that helps me kind of wrap my mind around the situation and what's going on, how to plan for it. And I guess we'll talk again here in a couple of days and do an update on what the Fed decides.
Yeah, I think it's, I would be shocked if they don't. They said they were going to raise the federal funds rate every meeting. But I would be shocked if it's not half a point instead of a quarter point,
Yeah, I do too. I agree.
And I think like what could happen if they think this isn't enough is you could get the federal funds rate maybe 3% at the end of the year instead of 2%, But I think that's like the type of adjustment we're probably talking about if in fact they're still behind the curve.
It's a big jump from here.
Yeah.
Well, thank you very much. I really appreciate it. Again, everyone, this is Finance Schminance. I'm Nick Rossolillo. Joining me today, Mark Evans, Professor of Economics Emeritus at CSU Bakersfield. And we'll catch up with you again here in a few days. Thanks everyone for tuning in.